Welcome. My name is Sara LaLumia, and I teach economics here at Williams College. Most of my research is about income taxes, and I study how taxes affect a variety of decisions that people make. I'm recording this in early April. It's been raining a lot, and our daffodils are starting to bloom. Of course, this makes me think of the familiar phrase that I'm sure you know: April showers bring tax preparation hours. That's how it goes, right? People are spending time preparing their taxes in April because April 15th is the typical tax filing deadline. In 2020, because of COVID-19, this deadline has been pushed back until July. Regardless of the exact date, what is the significance of the tax filing day? Note that I said that this is the deadline to file a tax return. There's an important distinction between filing a return and paying taxes. In fact, about 75% of tax filers receive a refund when they file. So for most people, tax day might more appropriately be called refund day. The distinction between filing a tax return and paying taxes comes about because of a system known as withholding. As a worker receives paychecks during the year, the employer has a responsibility to take some tax payment from each paycheck and submit that payment to the government. The process of filing a tax return involves reconciling what has already been withheld on the part of the taxpayer with what that taxpayer actually owes to the government. If the amount withheld exceeds what is owed, then the taxpayer receives a refund. Withholding from wages was introduced in the US with the Current Tax Payment Act of 1943. At that time, the modern US income tax had been in place for 30 years. During most of those 30 years, only a small sliver of the population paid income tax. For example, in 1940, only 14.7 million returns were filed. That represented about 11% of the population. These were the richest folks, and it was their responsibility to save enough money during the year so that they could pay all of the tax that they owed in one lump sum in March of the following year. Times of war have often been times of major changes in tax law. World War II was no exception. The share of the population required to file tax returns increased dramatically during this time period. In just 2 years, between 1940 and 1942, the number of people required to pay taxes more than doubled. In 1942, 36.6 million returns were filed. With many more households paying income tax, it was increasingly less likely that these families would have enough savings to pay their full amount of tax in one lump sum in March. There was also rising administrative pressure on the IRS to process all of these returns and payments in a short period of time. Thus, there was a push to introduce withholding. The idea was that by gradually withholding some tax during the year as a person earned income, there wouldn't be such a large lump sum bill to pay on the filing deadline. People already had some experience with the process of withholding. The Social Security system had been introduced in 1935. From its start, eligible workers had taxes withheld from their paychecks. Those withheld taxes were then used to finance payments. So withholding had entered public awareness, and it was working well for Social Security. However, transitioning the income tax system from its old method to a withholding system presented a unique challenge. If withholding began in early 1943, taxpayers would have seen an immediate decline in their paychecks as the current taxes for 1943 started to be withheld. But the early months of 1943 were also when people had to pay the lump sum for what they owed for 1942. This payment of two tax obligations at the same point in time would have represented a substantial burden for many taxpayers. One proposed method of handling this transition was to simply forgive all 1942 tax obligations. President Roosevelt opposed this idea, arguing that it would deliver the greatest benefit to the highest income taxpayers. That would have been a politically unpopular move, particularly in the midst of a war when many middle-income families were being asked to pay income tax for the first time in their lives. Perhaps more cynically, it's worth noting that many of the people who would have benefited the most from forgiving 1942 taxes were also rivals of Roosevelt. Regardless, a compromise was finally reached. Taxpayers could erase 75% of either their 1942 or their 1943 obligation, whichever was lower. After this compromise, withholding became an enduring part of the tax system. Advocates see it as a way to collect taxes efficiently and with lower mental burden for taxpayers. Detractors also point to the out of sight, out of mind feature, but not in a positive way. They argue that withholding has allowed government revenue and spending to increase more quickly than it otherwise would have. In 1954, the filing deadline was pushed back from March 15th to the now familiar April 15th. This change was combined with a major restructuring of the income tax. But it didn't change the fundamental idea of tax day as a day of reckoning. One of the most rewarding programs that I do at Williams is the VITA program, which stands for Volunteer Income Tax Assistance. Each January, some of our Williams students become IRS certified tax preparers. Together, we go to the neighboring town of North Adams and we file tax returns for over 100 local families. The process that I've described here in academic terms of reconciling the tax that people have had withheld during the year with the amount that they owe plays out in real life when we go and do those tax returns. I can't wait to get back into the classroom with my students, and I can't wait to start doing tax returns with them again. Whenever tax day arrives this year, I hope you will think back to what you've learned in the last few minutes about the current Tax Payment Act of 1943.